As stated in the previous video, we need to focus on the advancement of Taiwan's electronic components industry. As expected, Taiwan's Ministry of Labor released the most recent statistics on unpaid leave. The number of unpaid leave has reached 10,000 again. How are you feeling today? This video will provide us an analytical overview on the commodities market between September-November. It examines the price volatility of precious and industrial metals, energy products and agricultural commodities. During the period in question, the commodities market has demonstrated both upward and downward price movements, reflecting a complex interplay of supply and demand factors influenced by global economic trends, geopolitical tensions, and technological advancements. Please note this video only summarizes the international financial situation and the current political and economic development of various countries in the past week and analyzes it using neural-like algorithms, and summarize some real-time opinion with a book of changes for teaching purposes only. It does not provide real investment advice for any market. Let's commence the lesson by watching this video. Precious metals gold saw a modest increase in its buying price, reflecting its status as a safe haven. As said, amidst economic uncertainties, silver showed a slight uptick, indicating a but less pronounced reaction. However, platinum and palladium experienced significant declines in their prices, with platinum dropping and palladium not ably. These movements be attributed to decreased industrial demand and shifts in the automotive sector towards electric vehicles, which rely less on these metals for catalytic converters. Rhodium used primarily in the automotive industry for catalytic converters increase, potentially indicating a shorter-term increase in demand or supply constraints. Copper, a bellwether for economic health due to its widespread industrial use increase. Nickel saw a significant decrease, possibly due to the market adjusting from a supply shock earlier in the year. Aluminum and zinc experienced similar price adjustments, decreasing and increasing respectively, suggesting relative market stability for these metals. Energy commodities, both New York light sweet crude and Brent oil futures experienced substantial decline respectively. This could be indicative of market predictions of a slowing global economy, or responses to potential strategic petroleum reserve releases. Natural gas bucked the trend with an increase which be due to seasonal factors as northern hemisphere demand increases heading into winter. Heating oil fell in line with the broader energy sector declines. Agricultural products soybean oil futures decreased while soybean futures increased, possibly due to differing market dynamics affecting supply chains and production forecasts. Wheat futures fell, which could be impacted by expected improvements in supply conditions. Corn futures experienced a modest decrease while live cattle futures decreased, potentially reflecting market saturation or increased feed prices. Lean hog futures saw a significant drop, highlighting possible overproduction or changing consumer preferences. Sugar futures saw a marginal increase, suggesting a steady demand for this commodity. Cotton futures experienced a decrease, which be connected to trade uncertainties and shifts in global demand patterns. The observed market trends for commodities between September and November indicate a mixed economic outlook. The increase in gold prices aligns with investor caution, while the drops in oil prices could suggest concerns over future economic growth. The significant decreases in palladium and lean hogs reflect specific industry challenges, while the rise in natural gas prices could be attributed to seasonal demand patterns. To avoid risks, investors are advised to remain vigilant and diversify their portfolios associated with the volatile commodity market. Longer-term strategy should consider the potential impacts of technological advancements, particularly in the energy and automotive sectors, which could significantly alter demand patterns for certain commodities. We observe the performance of various currencies against the US dollar. Delve into the potentialities behind their movements. This period has witnessed fluctuations that reflect a dynamic global economic landscape influenced by monetary policy as geopolitical developments and shifts in trade dynamics. The euro and British pound both appreciated against the US dollar with increases respectively. This appreciation could be due to the market's perception of a more aggressive monetary policy stance by the European Central Bank and the Bank of England, aimed at controlling inflationary pressures. Conversely, as US dollar appreciated against the Swiss franc and Swedish krona respectively, the franc's decline could be influenced by investors seeking higher yields elsewhere, while the krona's larger fall reflect concerns over Sweden's economic outlook amid rising global trade tensions. There was a significant decline in the value of the US dollar against the Russian ruble and the Ukrainian hryvnia, the ruble's strength could be due to rising oil prices bolstering Russia's economy, while the hryvnia's relative stability suggests effective central bank interventions despite regional tensions. The US dollar depreciated against the Turkish lira, potentially due to Turkey's unorthodox economic measures and high interest rates attracting investors. However, South African rand showed minimal kanji, indicating a cautious market approach to South African assets. Against the Japanese yen, the US dollar experienced a marginal increase while it depreciated against the Chinese yuan. Japan's continued commitment to ultra-loose monetary policy explained the yen's modest movement, whereas the yuan's strength could be attributed to China's economic resilience and potential signs of easing US-China trade tensions. The US dollar appreciated slightly against the Indian rupee and against the Indonesian rupiah. India's economic fundamentals, including its large trade deficit, contribute to the rupee's performance, while the rupiah's depreciation could be linked to Indonesia's current account deficits and foreign outflows. The US dollar declined against commodity-linked currencies like the Canadian dollar and the Australian dollar respectively. This could be due to the rebound in commodity price, which typically benefits the economies and currencies of these commodity-exporting nations. The observed currency movements during this period are indicative of a complexable financial environment. The strength seen in the euro and the pound suggests their confidence in the economic recovery of the eurozone and the UK despite Brexit-related challenges. The depreciation in emerging market currencies against the US dollar, with the notable exceptions of the Russian ruble and the Turkish lira, could signal risk aversion due to concerns over debt levels and political risks in these regions. In conclusion, the foreign exchange market has shown diverse currency movements reflecting underlying economic strengths and weaknesses of their respective economies. Investors should consider these trends carefully, as exchange rate fluctuations can have significant implications for international investment returns. A nuanced understanding of monetary policies, geopolitical events, and economic indicators is essential for navigating the forex market. The commodities market has demonstrated variable performance, with precious metals like gold maintaining their status as safe havens, while industrial metals and energy commodities have shown more volatility. Agricultural products have also experienced varied price movements by both market-specific and macroeconomic factors. Investors should maintain a keen awareness of global economic indicators and geopolitical events when making investment decisions in the commodity space. Policy choices, market trends, and socioeconomic factors all affect policy decisions, making the global economy a dynamic and complex system. Our objective is to use neural networks to discover ways to be impacted by these concerns in regions where the worries themselves are exaggerated or misdirected. The difference between the appearance of facts and reality will be analyzed by neural AI algorithms in this series of videos. It is important to mention that this analysis is solely based on the most up-to-date transaction data. Long-term market trends may not be accurately reflected by this. Finally, I am very grateful to all viewers for their support. Feel free to leave a message if you're interested in any topic. If you feel that today's video has gained something, please remember to like it. I appreciate you taking the time to watch. Thank you. Thank you.